If you look at the long-term chart of indices like the S&P 500, then stocks look relatively calm on the surface as price chops around near record highs. But beneath that surface, there's a major shift taking place. Investors are rotating away from the most popular high-duration tech names, even some of the big AI companies, and into real assets and industrials. Now, the so-called Magnificent Seven got that name for a reason, because ungodly sums of capital have flowed into those stocks over the years. But now, the Magnificent Seven are starting to look a little stale. And if even just a small slice of the trillions parked in mega-cap tech rotates into smaller, less liquid, real economy sectors, the move could get wild. So today, we're looking at what might be just the beginning of one of the most significant shifts in the world's biggest capital markets. My name is Guy, and this is Coin Bureau Finance. Now, to get an idea of this major market shift, let's start with the face of the whole AI stock trade, Nvidia. Data centers keep getting built and big tech keeps hurling money at AI development, but Nvidia's stock has been chopping sideways for months now. And when the leader of a trade begins to show signs of fatigue after a parabolic run, the entire complex starts feeling fragile. Nvidia's good news reactions are starting to look like late cycle behavior. One week you get a headline that should be pure rocket fuel, big tech lining up something like a $650 billion AI spending plan, and Nvidia rips hard intraday. But then what? The market struggles to turn that burst into sustained momentum. But the real thing that should have your attention is the uncertainty. Analysts' estimates are all over the place, and questions about AI's true impact on productivity are being fiercely debated. That means the market doesn't actually know how to price the next leg of this cycle. At the same time, traders aren't sitting on their hands. They've been stepping up a rotation out of technology giants and into a broader bucket: small caps, value, cyclicals, anything that's geared to growth but doesn't require perfect AI monetization to justify the price. In other words, people are de-risking tech and AI concentration. But there are other signs of fragility in the AI hype train, such as Palantir. Now, Palantir's stock soared over 30x from 2022 to 2025, but now it's been getting hit hard. You had sessions where Palantir was down 9% or more alongside other high beta tech names, even while the Dow held up better. Now, what makes Palantir so useful as a signal is what happens before and after earnings. Usually, story stocks drift higher into their earnings print and soar if they beat expectations. But now we have a situation where Palantir isn't doing that. Share price has been tumbling hard even after an initial bump on a good earnings report. In fact, Palantir is among the worst performers in the S&P 500 early in the year. What's even more concerning, though, is that although it sits 30% or so off its all-time high stock price, Palantir is still trading at near triple-digit forward earnings. So, although the sell-off has been brutal in recent weeks, this could be just the beginning of a longer downtrend. And even good news from here might not be enough, considering perfection was priced in before. And it appears the big boys have started to read the room on this whole shift in mood. According to the latest batch of filings, big investors trimmed stakes in a whole load of the AI heavyweights. But there's other, perhaps more compelling qualitative evidence the AI trade is stressed. In late 2025, OpenAI CEO Sam Altman and Nvidia CEO Jensen Huang appeared together on CNBC to talk up Nvidia's relationship with OpenAI. The conversation floated a headline number of $100 billion, the implied scale of funding OpenAI would need for a multi-year infrastructure build-out. Now, markets heard it as Nvidia is in and the next leg is financed. But fast forward to January this year, and after reporters pressed Huang about that $100 billion figure, he began to walk the story back. He curtly said that rumours of dissatisfaction with OpenAI were, quote, nonsense. But the key admission was that the $100 billion figure was, quote, never a commitment. So, that's about as damning a public narrative downgrade as you can get. We then saw reports that the unfinished $100 billion framework was effectively shelved for a more immediate $30 billion equity-style structure. And, speaking of OpenAI, they're reportedly targeting about $600 billion in compute spend through to 2030. In other words, as we know by now, it's hardly a tidy software story and much more of an infrastructure megaproject. Inference costs are ramping up hard and margins are getting even worse as usage scales. And although we don't know the exact figures as it's a private company, OpenAI is far from being profitable. So, when the most prominent brand behind a trade needs that much capital just to keep the lights on, you begin to see real warning signs for the whole AI sector, at least at current valuations. And valuations are at the core of what has caused the broader shift not just in AI, but tech as a whole. For starters, AI stopped being a straightforward upside story. The numbers got so big that even great earnings couldn't keep the market comfortable. Big tech is talking about an AI capex surge in the hundreds of billions, and investors are now beginning to ask harder questions about what the ROI is actually like on that spend. And once that doubt creeps in, the market starts to get tougher. Huge chunks of market value have been shaved off the biggest AI-linked names as investors react to the same core fear. Spending is racing further ahead of clear near-term payoff. Even if analysts take for granted that AI will be transformative technology, questions about profitability and ROI are everywhere, especially as the spending curve steepens and competition piles in. Incidentally, there's a quirky bit of evidence for how the nervousness around this capex has gotten out of hand. Apple, which notoriously stayed out of the AI capex madness, rallied nicely as most big tech names faced a heavy sell-off in early February. While everyone else is out there trying to win the AI Olympics by basically setting money on fire, Apple is viewed by many as the anti-AI panic trade. Apple beat other tech stocks by the widest margin in about a year, as investors rewarded the idea of discipline over spectacle. Now, here's where the market gets a bit twisted in its cruelty. Although there are questions around capex sustainability, ROI, and profitability, the market also believes AI is going to boost productivity in the long run. The relevance of that? Well, it means software stocks, which are expected to be disrupted by AI in the long run, can still get trounced even while there's AI skepticism in the air. If in-house AI agents can do more work inside the stack, then why exactly would customers pay for a software as a service subscription? And recently, during an intense wave of selling, the S&P Software and Services Group shed around $1 trillion in market value in a single week. Names like ServiceNow and Salesforce got hit the hardest. Now, the degree to which AI will actually disrupt software as a service is another highly debated topic and one we don't quite have time for today. But the main point is that a core piece of AI optimism has become software as a service pessimism. And that fear can spread. The so-called AI scare trade has spilled from software into sectors like real estate services, insurance, and logistics, anywhere investors think automation could compress margins and replace labor. So, no matter how you slice it, the tech and software complex is taking hits from multiple angles at once. And finally, we saw a couple of perfect case studies in why software looks exhausted. A product drop and a simple claim can wipe billions off an entire niche in a matter of minutes. Cybersecurity stocks got whacked after Anthropic introduced Claude Code Security, an AI-powered tool that scans code bases for security vulnerabilities. Then IBM stock collapsed 13%, its biggest one-day fall since 2000, after Anthropic said its AI can upgrade old IBM mainframe code much faster, threatening IBM's lucrative legacy system business. So, Anthropic claims that AI features can be quickly bundled and priced aggressively to compete with all manner of software services. That is a potential nightmare for any software business that thrived on premium margins for specialized workflows. Now again, the degree to which Anthropic's claims are accurate is not entirely clear yet, but what's very real is market fear. And if you want to keep up with what's going on in the market, then the weekly Coin Bureau Finance newsletter is what you need. That's where we break down key moves across markets, macro, politics, and more so you can stay informed. It's absolutely free and we only cover what matters most. And we also have exclusive deals for Coin Bureau Finance viewers. Discounts, bonuses, and promotions put together exclusively for viewers of this channel. All you have to do is click the link in the description or scan this QR code. And now, back to the video. So, the market is not exactly sure what to do with the AI names, and AI-disrupted software stocks have gotten trounced regardless. But that capital isn't disappearing. It's just got tired of tech narratives, and it appears to be more interested in hard assets and industrials that can bill for real-world constraints. And those constraints are showing up first in power. Utilities are now a growth sector again because data centers and industrial loads are exploding. Major utility holding firm Southern Company just raised its 5-year capital spending plan to about $81 billion for 2026 through to 2030. That's a big pipeline of steel, transformers, switchgear, and wire. Meanwhile, despite AI uncertainty, the hyperscalers are still pressing the accelerator. The biggest tech firms are collectively expected to spend at least around $630 billion this year on AI-related capex, with Amazon leading the charge and Alphabet close behind. But even the best capitalized companies on Earth can't brute force physics. Amazon Web Services is getting blocked in Europe by grid connection delays that can run up to 7 years, versus roughly 2 years to actually build the data center in the first place. So, this whole build-out keeps spilling out of software and into energy infrastructure, engineering, and raw materials. The International Energy Agency has projected a massive surge in global electricity demand through 2030, and it says that demand will require annual investment in grids to rise by about 50% by 2030. So what we have here is a real capex cycle hiding underneath the AI story. Not just servers, but all the ugly infrastructure and raw materials nobody photographs for the keynote slides. So it's worth asking, in this shift, which real assets stand to benefit the most? Well, that brings us to copper. The race for upgrading energy infrastructure, building out AI, plus a ramp in defense spending for good measure, is all set to intensify a projected copper shortage. That is a simple setup. Demand is accelerating across multiple fronts, and mine supply isn't exactly elastic. According to research from S&P Global, copper demand could rise from about 28 million tons in 2025 to 42 million tons by 2040, while the deficit could reach 10 million tons by 2040 without a major supply response. And the story only intensifies if we look at the supply side. Chile's Mining Council, with Chile being the world's largest copper producer, warned that even with a pro-growth political agenda, any meaningful production increase is still years away. Years. Copper projects are slow, expensive, political, and hard to scale, and that's before you even get to refining constraints. Near term, the official numbers are already starting to reflect this squeeze dynamic. The International Copper Study Group revised its outlook last year and said slower production growth is expected to push the refined copper market into a deficit by 2026. And then you've got the long-term investment problem sitting on top of that. According to data from Wood Mackenzie, only about $76 billion was invested from 2019 to 2025 versus the roughly $210 billion needed by 2035. That gap doesn't close because the price had a good month and more production is incentivized. No, it only closes when capital commits for a decade. But copper is only one out of many examples here, because this shift from digital-first leadership into the physical economy is showing up all over the place. One strong signal of this is that governments now acknowledge raw materials as strategic infrastructure, not just commodities. The US is now floating the idea of a preferential critical minerals trade bloc with coordinated policy tools designed to loosen China's grip on the supply chain. The US also just signed a joint investment framework with Uzbekistan aimed at joint investments in exploration, extraction, and processing. This comes with a US development financing arm and a proposed joint holding company to back future projects. And so, this is becoming one of the market's favourite themes right now: long cycle spending that has policy behind it. Meanwhile, defence is another part of this industrials rotation that doesn't really need much imagination in the current geopolitical environment. Defence giant BAE Systems just posted record annual sales and a record backlog as we enter a world where governments commit to long-term rearmament programs. That backlog is industrial demand made painfully clear. You end up with multi-year orders that pull through copper, steel, electronics, engines, and an entire supply chain. The US side is doing the same thing, but with more capex pressure. The top 5 US defense contractors are expected to boost capex sharply in 2026, with the carrot and stick messaging from Trump being loud and clear. US contractors will accelerate deliveries and invest in capacity, and will stop treating buybacks as the standard use of cash. But it's not all about industrials when it comes to this hard asset rotation. As you've probably noticed, precious metals have also benefited. Gold is not relied on heavily when it comes to industrial output, but it is the #1 bet in town as people become increasingly skeptical of the stories being spun by politicians and tech bros. Global gold demand hit a record in 2025, with investment demand surging as geopolitical stress and currency confidence questions drove flows into bars, coins, and ETFs. Different drivers than an industrial metal like copper, perhaps, but it's the same market instinct. People are shifting from digital narratives to real things. Now, although that rotation out of tech and into harder assets is the main theme, at least for this video, we should note that there are other sectors benefiting from the shift out of tech. Take financials, for example. America's biggest banks added about $600 billion in market value in 2025, with deregulation expectations helping to drive gains. Now, if we layer on a steeper bond yield curve, which is typically a tailwind for bank earnings power, then financials turn into one of the most compelling ways to express a pro-cyclical, pro-real economy regime. But you don't have to take our word on any of this. You can also look at the market positioning of the most successful traders on the planet. Take market legend Stanley Druckenmiller, for instance. His latest 13F filing reflects all of this: a big rotation into an equal-weighted S&P 500 ETF, Southern Copper, and financial sector ETFs, among other reallocations. So, the market is changing in a big way in early 2026. Instead of focusing on fantastical stories of tech utopias, people are asking hard questions about how we're going to build the future. Some analysts are calling this the sharpest broadening in decades, depending on how you measure it, of course. But in any case, the equal-weighted S&P 500 is outpacing the headline index so far this year. When the median stock starts carrying its weight, what was over-concentration in the Magnificent Seven gets exposed. That positioning then starts to feel riskier for those all in on what has been a dominant tech trade over recent years.
I'm all in.
Now, of course, that broadening changes what gets rewarded. If your business can protect margins and generate cash without begging the market for endless funding, well, you're back in fashion. This rotation into value has echoes of previous regime shifts where investors stopped paying any price for growth and started opting for pricing power in the real economy. But just to be clear with all of this, we're not claiming AI is totally dead, but AI will have to justify itself. The market has started to punish big spending tech giants and software names while leaning into the real economy businesses supporting them. In other words, the market is still partly chasing AI, but it's doing it through cleaner cash flow lines and tangible demand. But here's the exciting thing about all of this, if you're active in markets: scale and liquidity. Trillions of dollars have piled into mega-cap tech over decades. Assets like industrial commodities and the equities tied to them are much smaller ponds. If even a modest slice of that capital rotates into these less liquid, real stuff markets, then prices can rip higher because there isn't enough inventory at the old levels. So, it's quite possible that we're only at the beginning of what will be a seismic shift. And it may only be amplified by the fact that a flood of capital will be eager to enter relatively less liquid markets. If this trend continues, things could get very real very fast. Well, that's about all we're covering today, but what do you reckon? Is this just the beginning of a long-term shift from digital to hard assets and industrials, or is this just a temporary rebalancing? Let us know your thoughts down in the comments. And speaking of hard assets, if you want to learn more about the wild price action from gold and silver in these unprecedented times, then you should check out this video right over here. That's all from me for today though, so as always, thank you for watching, and I'll see you in the next one. This is Guy, signing off.